What I want to do in this video is give you some background on our strategy and talk a little bit about how it works. So let's start off by taking a look at the stock market in general and how it works. So the stock market will have its ups and its downs. When it's up, it's called a bull market. Alright, and then it'll start going down. This is called a bear market. And sometimes there's extended periods of time in which the stock market doesn't go up or down. It just kind of stays flat. But generally over time, you'll see that the stock market, through all of its ups and downs, has an upward trajectory. It'll continue going up over time. And in fact, if you pick any date in U.S. history, 11 years from that date, the stock market will always be up, and you will have made money no matter what point you invested at. All right, so this is what the market generally does over time. All right, it has its ups and downs, and then continues up. So overall, we're looking at every year about an 8 to 10% increase, which is great. Now, people generally invest in the stock market. What they're looking to do is just ride these waves up and down. And then one day, when they're rich enough and they plan on retiring, they'll sell their stocks and pull money out, or they'll pull some money out and keep the rest of it in. But what's unfortunate about that is that, as great as it is, people generally don't see any money from it until they're ready to retire, until they're at a point much later in their life. And when they do actually take their money out, they'll be very happy, because if you've invested and you've done so with discipline, then you'll have made money over time and you'll be very happy in your retirement. But for us, that's not how we like to do things, because we want to have the opportunity to make money and bring it home and stay on top of the market and make money over time and make more than just what the market would normally bring you. So the stock market is the yellow line. Let's make ourselves the blue line here and describe how we do things. So let's say you start off with a certain amount of money and you're riding the market up just like everybody else. You're in the bull market, you're enjoying it, you're making money. And then you see signs that the market is starting to level off. Stocks aren't going up as quickly as they used to. They're flattening out. And this means that the market has increased enough in price that we're starting to see resistance. And resistance means that sellers are coming into the market, they're taking advantage of the increased prices, and they're going to start selling their stocks. They're going to take their money while they're up and run with it. Now, what we're going to do, since we're not ready to cash out all of our stocks yet, we're going to do what's called selling a covered call. And we're going to squeeze some extra money out of the stock market. We're going to squeeze some extra cash, all right, through selling that covered call. And I'll be explaining this strategy in more detail in a later video. But for discussion, let's say that what we've been able to do is sell this covered call, and through that we've made an extra $100. All right, so we'll be conservative and say we made $100 on it. All right, and now that's our money. You can do whatever you want with that money, whether you want to continue, you want to reinvest it, you want to pay off debt, you want to cash out and go have a steak dinner, whatever you want to do, that money is yours. All right, it comes directly out of it. If you want it to, you can pull it directly out of your investment account and do whatever you want with it. All right, but now, no matter what you do, you're going to be $100 above the market. You get to keep that money. All right, so as the market goes down, we're starting to ride it back down along with everybody else. We're still $100 up, $100 above where everybody else is, and $100 above where you would be if you didn't use this strategy. So now the market has gone down a little bit, and we're going to start to see things leveling off again. So rather than seeing resistance like we saw over here, we're starting to see what's called support. And that means that the stocks have gone down enough, investors are interested, the stock market is low, they're going to buy stocks, and they're going to take advantage of the nice low prices. Once we start seeing signs, volume is picking up, and I'll explain what volume is in another video, and the prices are starting to level off, we're going to squeeze some extra cash out of the market. We're going to squeeze cash from this bear market and essentially build a bridge to the next bull market. All right, and now let's say, just for discussion, that by selling a cash covered put, which is what this strategy entails, we make an additional $100. So when the stock market goes down, we sell cash covered puts. When the stock market goes up, and it's kind of hitting a peak, we sell covered calls. So now we're going to continue riding the stock market up. Now we're not $100 but $200 above the market. We're riding it up, and then again we're starting to see some resistance. The stock market is leveling off. We're not seeing quite as much volume as we used to. It's looking like things might start to go down. So again, we're going to sell a covered call, and we're going to squeeze. Let's say we got we scored this time. We did well. Actually, this is probably about average what you should expect to see. Let's see what we were able to do is get not $100 but $200. And that's a pretty fair amount of money to make on a trade like this. You should generally expect between $150 and $200 when you use this strategy. So now what we've done is we've squeezed not $100, $200, $300, but $400 out of the stock market. We're $400 above where everybody else is who's just riding the market, and $400 above where we would be if we weren't using this strategy in order to make additional money. All right, so just like we expected, we've squeezed money, and the market is starting to go down. And again, we're going to see some signs of support. All right, things are leveling off. Stocks they're not going down as much as they were. We're starting to see some more support. So what we're going to do is use the same strategy again, and you'll see how this continues. So again, we're going to squeeze. We're going to sell a cash covered put and pull an extra $200 out of the market once again. All right, so I won't bore you by continuing this any further. Let's just say we're going to continue. You can see that our trajectory, our investment is actually getting substantially higher, because now we're a full $600 above where the market normally would have us. So we're getting quite a bit extra out of it. So now to put some numbers to this, this is generally what you should expect to see if you invest about $50,000 4 trades later. So we're looking at about a month, maybe 5-6 weeks afterwards. And what we've done is been able to pull $600 in extra cash out of the stock market. So we're going to get a little extra bread here. That's pretty nice. So $600. And you might say, Mikey, what's going on here? I invested $50,000, and the best your strategy can do is give me just give me $600. That's all you got for me. Yeah, in some ways that's true. But remember, we're not just benefiting from the extra money that we've made. The stock market has gone up over this time. So we started off way down here at just $50,000. All right, but look what the market's done since then on its own. All right, without our strategy, we started with $50,000. Now up here, we're probably about a month later. On a good month, you might make 2%. So let's say that what we're actually at the end of the month isn't $600, but the market has already given us, let's say we're at $51,000. Just in the stock market alone is at $51,000. And then by using our strategy, we're able to add an additional $600. So we're not at $51,000 making a 2% return. We're actually now at $51,600. All right, 2% in a month is already pretty good. That means that the stock market has gone up very well. But now we're looking at not just that extra $1,000, but an extra $1,000. This is 6 here. Forgive the 6. An extra, we're looking at more like 3% here. So we've done a little more than 3%. So this would be a great month for us, making an extra $600 on top of $1,000 already. And in other months, you can actually see that this is even more dramatic. So by being able to continue the strategy, you end up making a pretty substantial amount of money on top of what the market already gives you. And I've personally been doing this for a couple of years now, and it's worked wonders. You can really tell the difference when you're looking at the end of the year and seeing how much money you've made. And I'm going to continue using it because it works out so well. I'm really not kidding when I say that this is probably the easiest way, the most basic way to add to your income over time, rather than just invest passively. So let's take a look at what an actual stock chart looks like. So this is the S&P 500's ETF. Now, of course, it's a lot more choppy than what I actually drew online just for demonstration purposes. But you can definitely see circumstances where the stock market has gone up. All right, now it's starting to level off. And what we would do is sell a covered call in this case, and we would have a little extra money on top of that. So an extra couple $100 we would walk away with. Now, as the stock market goes up and down, whatever it does, we're going to keep that money and we can use it, we can reinvest it. All right, and here you see a downtrend. All right, in this case, it kind of spiked back up, so it would be difficult to time. But we look for opportunities to do it. We can start to see that there was the market had gone down substantially, and then we started seeing these are called candles, smaller red candles. And we would take this as an indication that the stock market is going to reverse trend. And we would sell a cash covered put. All right, so we'd build that bridge to the next bull market and walk away with a little extra. and we would continue climbing. All right, so this is a good example of how we would actually use that strategy in real life. And now at this point, it looks like the stock market has finally taken a hit. We've been anticipating for a while. We sold some calls, and we actually sold stock in this case too because we expect it to go down. And now it looks like that trend is starting. So we're going to wait for it to go down a little bit more, and then we're going to sell a cash covered put and take away that little extra money once the market starts going up again. All right, so in conclusion, this is the gist of our strategy. There's some risks that are associated with it, even though it is one of the lowest risk strategies that you can use in the stock market. So what I'll do in the next video is describe a little bit more in some detail about how we actually use this strategy and talk about how we can manage the risks that are associated with it. All right, thanks for watching.